Hello, my name is Magnus Petersen. This talk is about valuing acquisitions or investments that a company pays for with its own stock. The question is how this affects shareholder value. First, we need to define the value without the acquisition, and we define that to be the potential for dividend payouts, which we denote by a small v, and it is the excess cash that the company could pay out as dividends now, plus the present value of future earnings. The value per share and after dividend tax is denoted capital V. The value with a share issuance and investment is denoted capital W subscript issuance. There are two effects on the value. The first is that the return on the investment is added to the value V. The second is that there is dilution in the number of shares because of the stock issuance. So if we just go over the formula up here, we need to add to the value V the issuance amount. We then subtract the investment amount, but those are the same, so it comes out to 0, and then we add the return. And we end up with this equation down here. The relative value of making the share issuance and investment compared to not making it is simply the value capital W subscript issuance divided by capital V from the previous slides. And when we reduce the mathematical expression, we end up with this. The equilibrium is where the value to eternal shareholders is unaffected by the share issuance and investment. We usually write this out as an inequality so we can see clearly when the value is increased from making the share issuance and investment. We have the value with the share issuance and investment. That is difficult to say. And it is greater than the value without the issuance and investment whenever the market cap is greater than this value over here. And this is found simply by inserting the definitions from the previous slides. It is sometimes useful to rewrite the expression. So, for example, we can compare the value V to this number over here, or we can consider the return on the investment, which must be greater than this value over here in order for the share issuance and investment to increase value to shareholders. Now consider a case study, which is a recent acquisition of Facebook of the company called WhatsApp. And here are some facts. It was announced on February 19th, 2014. The amount was $4 billion in cash, and there were a total of 230 million shares, and some of them were restricted so they cannot be sold within a few years or something like that, but we will ignore the restricted conditions and simply consider them to be ordinary shares, and there were 230 million of them. And the value of those shares on that day, because the price per share was about $68.50, so the value of the shares paid in the acquisition was about $15.8 billion. Facebook's market cap, that is the market value of all shares, was 175 billion on that day. So that is the market cap without the new issuance of these 230 million shares. The formulas for valuing the acquisition are net of the cash payment of $4 billion. So whenever we consider the return in the formulas, it is net of $4 billion, and we'll get back to that. Now consider the relative value to the shareholders of Facebook for making the WhatsApp acquisition. When the shares of Facebook are overpriced and the shares of WhatsApp are underpriced, then they both contribute to increase Facebook's shareholder value. So recall that the market cap for Facebook was $175 billion, and assume that the intrinsic value, or the true value to the eternal shareholders of Facebook, is actually only $140 billion. So the shares of Facebook are slightly overpriced. And now consider the return on the WhatsApp acquisition to be $19 billion, which is greater than the $15.8 billion which was paid in stock. So Facebook shares are overpriced and WhatsApp shares are underpriced. Again, remember that the WhatsApp numbers are net of the cash amount, so the issuance amount is net of the cash amount. This is only the amount paid in stock, in Facebook stock, and the return is also net of those cash. So the gross return would have to be plus $4 billion here, so the gross return would be $23 billion. Anyway, we use a relative value formula from the previous slide. We plug in the number, the intrinsic value or the net return for the WhatsApp company, $19 billion. The assumed intrinsic value for Facebook, V, which was $140 billion, and the issuance amounts of $15.8 billion, and Facebook's market cap of $175 billion. So the result is 104.2%. This means that the acquisition under these assumptions would increase value about 4.2% to the shareholders of Facebook. Now consider the opposite scenario where Facebook is underpriced and WhatsApp is overpriced. Then they both contribute to decrease the value to Facebook shareholders. So assume that the intrinsic value of Facebook is now $210 billion, which is higher than the market cap of $175 billion. Assume the return on the WhatsApp company is $12.6 billion, which is again net of the cash payment of $4 billion. So gross of that cash payment, it would be $16.6 billion. So again, we plug in the numbers in the relative value formula and we get out 97.2%, which means that the value to Facebook shareholders under these assumptions would decrease by about 2.8%. The equilibrium is where the WhatsApp acquisition does not affect the value to Facebook shareholders. Again, we write this as an inequality, so we can see clearly when the value increases from making the acquisition. First, we use the formula, which is written in terms of the intrinsic value of Facebook V, and we plug in the numbers: market cap of Facebook, $175 billion, return on WhatsApp, we can assume it's $12.6 billion, and the same as in the previous example. And the issuance amount, we know that is about $15.8 billion. So the result is $140 billion. So this means in order for the acquisition of WhatsApp to increase value to Facebook shareholders, the intrinsic value of Facebook must be less than $140 billion. We can also consider the equilibrium in terms of the return on the WhatsApp acquisition. And again, we plug in the numbers, the issuance amount of $15.8 billion, and we can now assume that the intrinsic value, or let's assume that the intrinsic value of Facebook is really $140 billion. We know the market cap is $175 billion, and we get out the result $12.6 billion. So it means that the return on the WhatsApp acquisition net of the cash payment must be $12.6 billion in order for the acquisition to increase value to Facebook shareholders. Again, this is net of the cash payment, so we have to add $4 billion, which is the cash payment, to get the gross return on the WhatsApp acquisition. This is a plot of the relative value of Facebook's acquisition of WhatsApp, and we have simply used the definition of the relative value formula from one of the previous slides, and then we have different values for WhatsApp and for Facebook. So this is Facebook's intrinsic value V. On this axis here, it goes from 0 to $300 billion. And this is the return on the WhatsApp acquisition, which goes from 0 to $30 billion. And this is net of the cash payment of $4 billion. So that would have to be added to this axis to get the gross return on the WhatsApp acquisition. The market cap for Facebook is this line here, and the acquisition price, $15.8 billion, is this line here for WhatsApp. The bold line that we see here is the equilibrium, where the acquisition does not change the value to the shareholders of Facebook. So on this side up here, the value is increased to Facebook's shareholders, and on the other side of the equilibrium, the value is decreased from the acquisition. Note that the function is nonlinear. This is just a zoom of the previous plot. Now the Facebook's intrinsic value goes from 140 billion to 210 instead of the full range. To summarize, the value of an acquisition paid in stock depends on the mispricing of the shares of both the acquiring company and the acquired company. This talk is based on the treatise on share buyback valuation because the subjects are closely related, and the treatise can be downloaded on this website, and the link is also provided in the description below the video.